Have you ever wondered how much home you can qualify for based off of your salary? In this video, I'm going to explain to you how much you can qualify for based off of $50,000 salary. And don't worry, whatever you make, you can use the same equation that I'm going to use to determine how much you'll qualify for. And honestly, you'll be surprised of how much you can qualify for just based off of what you make. What's up, YouTube? My name's Chris. I'm a loan officer located in the state of Florida. I make videos basically to simplify the home buying process, and I also help you achieve financial independence. So if for some reason you're interested in that type of stuff, go ahead and shoot me a subscribe. The United States median income per person is about $68,000. And when I say median, it's not average. Median is going to be half of America makes more and half of America make less. I don't really like to use averages when it comes to income. $68,000 is around the median income as far as 2020. Now, the median household price in the United States as far as 2020 was around $368,000. Honestly, predict this number is going to be a little bit higher based on the market that we're currently in. Now, basically what that means is if you were to buy a home for about $368,000, and let's say you put a down payment of 5%, your mortgage payment will be around $2,300 to $2,500, just depending on where you're located. Taxes and insurance, it always varies. And if the median household income is around $5,700 a month, and then the household debt, meaning that how much the mortgage will be, and this is total with taxes and insurance, will be about $2,300 to $2,500. It gives you about a 40 to 42% debt to income ratio, which is pretty much in good standing when you want to qualify for a mortgage. And this does not include any of the debt. Keep in mind, if you have student loans, car payments, credit card bills, we're just going to base this off of you paying off all of your debt. Now, how much home can you afford if you make around $50,000 a year? What do we need to know? First, how much debt does this person currently have? Why is this important? Because your debt to income ratio is going to be an important factor. I made videos about this in the past. I'm going to leave a card above so you can go ahead and click that after you watch this video. But debt to income ratio is important because that's going to determine how much you can afford, because we don't want to revisit a crisis we had in the past. Let's just say this person has no debt. He or she paid off their student loans. They don't have any car payments and they don't use credit cards. Now we have to determine what the person's credit is. Why is this important? Because credit is going to determine your interest rate by every point. That's why whenever I'm working with a client, we usually get to know each other first, and I try to ask them what their credit is like without running it, because once you run your credit, that's going to determine your interest rate, and then also how much you got to put down on the home and your mortgage insurance in some cases. And that's an important factor on determining how much home this person can afford. But in this case, we're pretty confident about our example, our person. Let's just say the person's credit score is a humble 680. Now we're going to determine how much the person is putting down. Obviously, down payment is going to determine how much you're going to qualify for a home. And if you have a question on how much maybe you should put down in your home, feel free to reach out to me. I'll determine that for you. I always talk about a strategy. I'm not going to go into too many details on it now, but feel free to reach out to me in the comment section or one of my other media platforms if you can, and I'll let you know what might be the most recommended down payment you should put. In this case, let's just determine that our person is going to be putting about 5% down, so regardless of what the loan amount is. Final thing we need to determine is where the home is located. The location of the home is important because it can be a condo and they have to pay condo fees, or it could be in a flood zone and they have to pay flood insurance, or it could be in a state that their cost of living is completely different. Like, for example, a home in Florida is going to be completely different from a home in Utah. That's very important. And for this example, we're going to say this person is located in the motherland, Florida. I have a calculator that I'm going to leave in the description. All you have to do is put your city and state in the calculator, and it'll calculate what you're estimated. Now, big emphasis on estimated. Taxes and insurance will be, I'd say take that with a grain of salt, because that does vary. All right, so now that we got this information, the person has a 680 credit score, the person putting about 5% down, they're located in the state of Florida. Now we can determine how much that monthly payment is going to be. Most lenders are going to require debt to income ratio for conventional loans at 46%. and then FHA loans of around 56%. I did do a video of the differences between the two. I'll leave a card above so you can go ahead and click that after you watch this video. That's gonna be the maximum debt to income ratio that you can have when you're trying to qualify for a home. I never recommend anybody max out that debt to income ratio. So based on the information provided, this person can qualify for a home of around $305,000. Most likely you're gonna get a condo if you're in the South Florida area. But if you go up north, you can get a decent size, maybe 2 to 3 bedroom home. It's just going to depend on the area in Florida that you're in. You'll see the differences between the homes in each area, and you'll be surprised. A $300,000 home in the state of Florida is going to look completely different than a $300,000 home in the state of North Carolina or Texas or one of those other states that cost of living is a bit different. And at $300,000 home, the total mortgage payment will be about $1,800 to $1,900. I'm using ranges right now. I don't want to give an exact number because it could fluctuate just depending on small details like insurance and taxes. I can't quote that, but $1,800 to $1,900 a month is a bit doable. Now, what you need to ask yourself is how much you're currently paying on rent, and ask is, you know what, if you're paying around $1,800 to $1,900, you could possibly qualify to buy a home. Should you buy a home? Now that's going to depend on yourself, and are you ready to buy a home, and do you have enough reserves for a down payment? Buying a home is not just a 1-2 punch. You do have to put a lot of factors into it. I think savings is very important. When you go into a home, most of the time you're gonna have to put a down payment. There are down payment assistance programs, but you still have to usually cover closing costs. What does this information mean to you? So if you're in the process of trying to look for buying a home, start planning it out. Buying a home can be a very fun process, but a lot of times it can be stressful, but you don't want it to be financially stressful. But yeah, that'll do for this video right now. If you found any value in this video, go ahead and hit that like button. Leave a comment down below of any type of questions that you guys might have in the home buying process, and I'll feature it in the next video. Other than that, I'll see you guys next time.